into our macro matters, there's been a slew of macroeconomic news, not least of which in Santon, the CBD, where the FOCAC summit is underway. And of course, the US is heading towards a hike. When and how much is the question? And of course, closer to home, we are on tenterhooks on the verge of that ratings verdict. And that should come out just as about the show ends. And to help us make sense of all of this is George Glynos, who's the Managing Director and Chief Economist at ETM Analytics. George, US interest rate hike, I think the number today, market expecting slightly less, so upshooting the market. Is this an endorsement that December is going to happen? Is this what we should expect?
You're talking about the payrolls
yes.
numbers, not the rate hike.
So the
rate hike in a couple of weeks' time, effectively not next week, the week after. Today's payroll is more of the same. I mean, there's been strong jobs growth out of America, so it's definitely more of the same. 211,000 jobs created. I'd say that's not bad in through the course of a month. So America's on course, I think, to hike rates. So we've penciled it in for what it's worth. We still think it's very much a realpolitik type decision. There's a little bit more to this than just straight up economics. I think the Fed themselves have painted themselves into a corner to the extent that they've televised this or telegraphed this so widely that everybody's expecting it. In fact, I think if they don't go ahead and hike, the impact on the markets could be even more significant.
Well, if you remember about a year ago, that's exactly what happened. The signals were very strong and reading the bones of the speech, and then they didn't do it. So they've been doing this for a long time.
Yeah, but I think they've learned from those sorts of mistakes, because they are mistakes. No one wants to bully the markets around or create undue volatility. It doesn't really help anybody, and it loses credibility.
Yeah, exactly. I was saying, I would think that the Fed would come under a credibility cloud if it goes just completely in the opposite direction of what has been communicating thus far.
Yeah. But I want to ask George something which I've been meaning to ask him for a long time, and then I think it was Greenspan, when Alan Greenspan was head of the Fed. It might have been someone else, but one of them said, as a matter of policy, I do not make comments.
Yeah.
I just announce. Because he says, whatever I say, the market is going to pick apart and interpret, and then they're going to make calls, and people might lose money as a result of the wrong call on what I say. Is that true? I mean, am I misremembering?
So no, that was very much Alan Greenspan. So yes. Greenspan was, and if you had a look at his speeches and his announcements post interest rate decisions, they were notoriously difficult to unpick. He used very verbose language, very carefully constructed sentences, not to give too much away.
But also after the announcement. He didn't preview the announcement so that you couldn't guess what he was going to do.
They've changed that. So through the course of the past...
change?
Well, I think it was, because what happened post-2008, going into 2009, they felt that they really needed to chuck the kitchen sink at things. So it wasn't just about QE. They wanted to make sure that the general public out there and general business out there understood that they were going to do whatever it took to get things back on track. And so they communicated very explicitly as to what they were going to do, how they were going to do it, and what they would get in return for what they've done.
How does that differ from the European experience of Mario Draghi and his committee, and how it plays out in the US? Are there similarities there?
Well, to some degree. I think Mario Draghi actually communicates quite well. But there's substantial differences between Europe and America, in that Europe, you've got this amalgamation of a whole bunch of countries that have got different fundamentals. And that ECB has obviously lagged the Fed by quite some time. They're much slower to move for a whole host of regulatory reasons, et cetera, et cetera. So difficult to compare the two, to be quite frank. And even now, you saw the disappointment in the markets this week when the ECB failed to inject more stimulus in the way of QE. And I think that's very much a Fed mentality being applied to Europe, but being disappointed when it doesn't happen. That's maybe the best example of the differences.
I think, just stay on, we can't talk about this all night, but it's like
it's just interesting when George does it.
I know. Is that our own Reserve Bank never used to make speeches and commentaries and things. I think it really started after Christel Swent and Tito Mboweni came in. And Tito Mboweni quite enjoyed chatting to the market and the analysts. And we sort of established a tradition there, I suppose.
Yeah, almost a little bit too much. I think there's a fine line to, you communicate a little bit too clearly, the markets price everything in.
Right.
And there's questions about the feed-through mechanism into the economy quite often. And there's been some literature written on this, where if economies and markets are surprised, you tend to get more bang for your buck in terms of the kind of response a particular central bank wants to elicit. So if they wanted a positive response, a surprise interest rate cut would have more of that effect than something that's been televised, for months and months and months in advance. So there's a fine line to tread there, and I think they try. I'm not sure that we always get it right.
George, closer to home, the rating agencies, we're all waiting the outcome of their verdict. What do you think is going to be on the headlines tomorrow?
Yeah, if I had to have a bit of a guess, because we've had some interactions with some of these ratings agencies. S&P are a little bit leading the pack, if you like, in terms of their credit ratings. We think Fitch is going to catch up. So we think Fitch is going to announce a downgrade. It's going to be for all the same reasons that we've heard of for all the past couple of years worth of downgrades. It's going to be the fact that growth is disappointing, that tax collections as a result of that are not strong enough. It's that the deficit's remaining uncomfortably wide. It's that our debt levels are building. It's that unemployment isn't coming down. It's about some social issues that have sprung up, whether you look at the Pick It Up protests, whether you look at the students protesting. There's a lot of that going on, and that disgruntlement, I think, comes out of a population that is feeling extremely frustrated at the lack of opportunities, the lack of jobs, the lack of dynamism in this economy that we need to get things going.
The last time you were in with us, it wasn't on Business This Week, it was Business Tonight, but you were actually angry about the way we are not responding to the challenges that are there. But let's not upset you again and then you upset us. Let's talk about China. And I heard a cynical comment the other day about what China does, this wonderful relationship. Everyone has a good time driving around Sandton with blue lights and getting
blocking
us in traffic
David
jams.
in traffic.
Yeah, I'm raising my personal issues.
And me.
Everyone. And the guests for our shows come in late.
Absolutely.
That we borrow money from China in order to buy stuff back from China at high interest rates, and they do all the building and the checking and everything.
Well, I mean, China is known for their vendor financing model. They applied it to the US very successfully. In fact, some of their strongest growth periods ever in China's history came at a time when China was effectively purchasing US treasuries, assisting keeping US interest rates low, keeping the strong dollar intact. And as a result of that, you saw the deficit between the US and China ramping up to record levels. It was a vendor finance model, if you like, between China and the US. The fact that it's now getting applied to South Africa is very much part and parcel of the way China often does business.
But I wonder if we have our eyes open with this.
Well, I think it's very tempting. The reality is, David, that they can produce things at very competitive prices, at more competitive prices than we can. Now, when in this world, and you must appreciate, South Africa is a capital scarce country. So when you get given the opportunity to raise capital at attractive rates, and you get given the opportunity to purchase machinery, equipment, potentially for the purposes of building infrastructure at attractive rates, it is quite an enticing thing to try and take advantage of what you need to do. So I don't necessarily have a problem with that. I've got a problem more with how we manage the rest of the economy and how we ultimately make the books balance, which at the moment we're not doing.
So if we look at some of those capital injections, 500 million for Eskom, Transnet also getting a big 2.5 billion, lots of money coming through. And as you're saying, that the issue is not so much about the actual loans and these capital injections, it's the other issues that we need to be working on outside of these big infrastructure spends.
So, Nozi, here's the thing. I mean, if we were a country that was running a very low budget, budget deficit, and we weren't experiencing increases in debt levels, and we had a credit rating which was stable in investment grade, and people were lending us all of this kind of money, it offers us options that we don't necessarily have to borrow from China. We can borrow from a number of other interested parties. We can then pick and choose. You then have more options available to you to make the best possible decision for your country. The problem right now is that South Africa is stuck between a rock and a hard place. We need all of these things, but at the same time, we've been experiencing credit ratings downgrades. Our fiscal position has deteriorated such that foreign investors are now looking quite cautiously at South Africa as an investment destination. Interest rates, if you have a look at our bond yields, have risen across the curve. So all of this makes our borrowing a little more expensive. It narrows the options of availability in terms of capital. And so, again, the point is, you're quite right. It is about all of these other issues. It's about how you manage the rest of the economy and how you make the fiscal position such that it empowers you rather than pushes you into a corner where you have limited options and you tend to go down an option which perhaps is okay at the end of the day, but maybe a little suboptimal. You'll never know, really, at the end of the day. You'll never know because we don't know what the other options could have been. But look, at this point in time, we are capital scarce. We need infrastructure built. I say let's go down this route, but I just wish we could try and cut back on some of the expenditures elsewhere.
Yeah. Final point, the rand. We were commenting on sort of the symmetry with which it moved over the couple of weeks. It went from 14.44, the weakest ever, down to 13.99, 14 basically, back to 14.44 again over a 2-week period. And it's sort of settled in that 14.20s to 14.40s. Looks like that's where it's going to be for a while.
Yeah, look, I try not to focus too much on the very short-term stuff with the rand. So we have a look at the currency in a slightly different way. We've built a rand sentiment indicator which gives us a great leading perspective, and that, unfortunately, at this point is telling us very much that the rand's still in depreciative territory. We also look at the rand in terms of fragility. So we have a barometer that we've built up to gauge fragility, and that fragility is still running at very high levels. So even though it's stabilized, I think the way we looking at it at this point is that we still very much rand bears. We believe that there's still an adjustment that needs to happen on the currency in order to rebalance the balance of payments and the capital account, the current account. So that needs to happen, and we think we could still see another 10-15% adjustment on the currency. So that would, what does that take us up to? Maybe $16 to the dollar?
Him to send us this barometer,
this fragility rating,
right?
Yes. George, thank you so much for making the time to join us. David and I are learning something new, that the rand has fragility levels that we need to find out about. George Glynos, Managing Director and Chief Economist at ETM Analytics.